All right, what up, everybody? This is Jeremy with Escape Velocity Trading coming at you for the weekly market bias update report for Sunday, December 29th. This is the last few days of the trading year for 2024, and this week we will shift into trading for 2025. And as such, we are going to do something a little bit differently moving forward for the weekly market bias update report. We are still going to be starting off with our weekly review. So, looking at our trades this last week, I had four different trades, three wins, one loss. The loss outsized the wins there, and I ended up losing $4,150 for the week with just minimal trading last week with the holidays. Going out to our trading and what is going to change for our market bias update report moving forward, instead of looking at the futures, recognizing that a lot of people watching this channel are newer to trading, and the futures may be shying some people away from diving in. Instead, we are going to be looking at the four major indexes here, the ETFs that track the S&P 500, the Nasdaq, the Russell, and the Dow Jones. And then, depending on where I see things moving in the market, we will dive into some of our sector analysis for the 11 major sector ETFs that track the market, as well as gold, silver, the US dollar, and the Bitcoin and Ethereum ETFs from BlackRock. So, with that, let's dive right on in and get going with our analysis. So, starting off on the S&P, SPY is our ticker. We are in a very similar place right now that we have seen multiple times this year. We have come down, we have broken our 20 period SMA, the line in blue. We are underneath our green 9 EMA, that is our exponential short-term moving average that signals our momentum. And we are sitting on the rising 50 here in pink. That is our longer term moving average that we really do not want to see price violate and hold below for any length of time. Now, quick little tip or trick with moving averages. When your shorter term moving averages are above the sequentially longer moving averages, like you can see through here where the green is above the blue, is above the pink, is above our long-term 200, that is bullish conditions. When you start to see the shorter term moving averages cross underneath some of the longer term ones, that is a signal for caution. And if those continue to invert and the shorter term moving averages continue to fall below the longer term moving averages, the more that that happens, the more bearish you need to become. Right now, I am seeing caution in the market. This isn't a, oh my God, sell everything moment, but it is a moment to recognize that this bullish movement is over and we are now into some form of consolidation where the market is trying to figure out if it is going to hold this zone and eventually work that off and try to move higher, or if we are in a shifting phase where this breaks the 50 period moving average, closes below it, and this is that one last retest of the 20 before rolling over and a larger sell-off to come. Now, if we move this and look at it within our analysis of our MACD and our RSI has sold off harder with this drop than we have seen in quite some time. It is bouncing off of the bearish territory and still within bearish territory, but not oversold yet. And our MACD has crossed below the zero line, signaling potential bearishness. So with this, caution is warranted in the S&P. Now, if we go out and look at the Nasdaq, this is the QQQ. You can see we are still holding the 50. Our 9 EMA has not crossed over below the 20 yet, but is threatening to. Has a very similar look on the price chart, but our moving averages are still signaling a little bit more bullish than bearish right now. And the RSI is just barely crossing into our bearish territory, not fighting the overextended to the downside line like the S&P. And our MACD is still in bullish territory here. So what this means in large part is that big tech has been holding up the rest of the market and that we are not seeing as much damage in the Nasdaq as we are in the S&P, or as you'll see in a second, the Russell or Dow Jones. So caution warranted, not as much here, as long as big tech like Apple and Amazon and Google and Microsoft, as long as those charts stay intact, as long as the bullish momentum holds in on those charts, the market should hold support. But if those start to weaken and give out, and we see the Nasdaq start to lose its ground on its moving averages, that is going to spell further trouble for the S&P 500. Now, going out to the Russell 2000, ticker symbol IWM, you can see we have not only broken below the 50, but we are trending significantly below the 50 and having a very hard time breaking back up above and reclaiming the 9. So this is more bearish than either of the other two charts. Right now, the QQQ is the strength, the S&P is in second place, IWM is in third, and if we go out to the Dow Jones, I would say it is tied for third with the Russell 2000. So weakness in the Dow Jones and Russell currently, strength in tech, and overall general hesitation in the S&P. Those are our four major market indexes. Now, going out to the sectors. If we go out to basic materials, looking at XLB, you can see we have had a huge sell-off here. We are super overextended to the downside. I would not be surprised to see this level hold for a short bit, maybe a small term counter rally. But if we put this out to a weekly time frame chart, you can see we are also sitting on a very important support level here at the weekly 200 period moving average. Each time in the past that we have come down and tested this zone, it has held and we have started a new bullish leg. So it is reasonable to expect that that might happen here as long as the rest of the market can stay intact. If we do see more selling pressure and more profit taking in the larger market itself, this may very well break and lead to further declines. So waiting to see right now what happens at that important 200 period moving average on the weekly is going to be very, very important. I am not going to be looking to buy this dip until I see a series of higher highs and higher lows on the daily chart, signaling that there is a new trend intact. Going out to our consumer discretionary, you can see here that we are in kind of a consolidation pattern that looks pretty similar to the S&P 500, breaking down into bearish territory on the RSI, still in bullish territory on the MACD, signaling a little bit of confliction between those two indicators, but we are threatening to break down below the 20 SMA, and with that, the 90 EMA will cross it in the next day or two if more weakness comes in. For me, this looks like either triggering to the upside if we can get back above the pivot here around 234 and 50 cents, or more likely, in my estimation, triggering below the candle on Friday and then triggering to the downside, looking to profit to the downside back down to the 50 period SMA. Going out to tech, this is the technology sector ETF. It should be no surprise here that it is still holding support pretty well. It has basically flatlined and has had a very hard time breaking above that 242 area. If this does break down below the 50 here and below this pivot low, the rest of the market is likely going to take a leg lower as well. This is going to be a very, very important chart for the rest of the market and market sentiment as a whole. So keep an eye on tech. Make sure that if you are in trades, you are tightening up stop losses in tech just in case it does lose ground and rolls over. But right now, a breakout above 242 with good volume to support it would be signaling that the buying mentality is alive and well in the market. If this instead breaks down and we start to see this trend lower, tightening up stops, exiting out of positions, locking in gains, and then looking to short on the downside would be prudent. Going out to XLE. This is the energy sector ETF, and you can see a massive, massive sell-off here. If we toss this to a weekly chart, you can see we still have some room to fall before we get back to the 200 period moving average. I wouldn't be surprised based on where the daily chart is to see a little bit of a reprieve bounce to start this week, and then followed by rolling over and eventually testing this rising 200 with a drop down to somewhere around $78. Going out to XLU. Putting this back out to a daily chart, you can see we have kind of a double top formation here. We have come down and are threatening to test the 200 period moving average. I wouldn't be surprised to see a little bit of a reprieve rally and then a rollover on this as well. Going out to XLP, consumer staples, we are sitting right at that 200 period moving average, and I hope you are sensing a theme here. It is not usual for prices to test that 200 period moving average in strong bullish trends. We tend to test the 200 period moving average when things are a little bit uncertain. And right now we have some uncertainty because we have a new president that is going to be sworn into office in January, and we don't know what his policy impact is going to be, especially around proposed tariffs and things like that that might hurt the battle against inflation right now. So that is the big storyline that the market is struggling with and trying to wrap its head around to see where the market wants to go next. Is it going higher or is it going lower? That is always our question. If we put this back to a 3-year weekly chart, you can see that we did have a slightly decreased high there. We have now put in a lower pivot high and a lower pivot low here. So that is technically a downtrend. Whether or not we can hold this support level is still a question, but it does give us a little bit of confidence, at least, that this is an incredibly strong support level. We have tested 1, 2, 3, 4, 5, and now 6 times in this exact same zone around $78. So it should at least fight to hold that area. If that area does break, however, it will signal further declines to come. Going out to communications ETF, we are starting to break down here as well. The 9 is rolled over underneath the 20. So far, we are holding the 50. Pretty much all of these charts to me look the same. They are saying it is not bearish yet, but it is definitely not nearly as bullish as we were before, and some caution is warranted. If we do get back above $100 on this, that would signal the next leg higher. If we break down instead below the 50-period moving average here that is currently at 96.46 cents, that would signal further declines to come. Going out to industrials, we've already rolled over, and not only has the 9 rolled below the 20, but now the 20 is actually rolling below the 50. So this is the second level of breakdown within our moving averages. If we toss this out to a weekly chart, you can see that we have some room to fall here until we get back to not only horizontal support, which we had tested multiple times throughout April through July, but also coordinating pretty closely to that rising weekly 50. So that is kind of my price target for XLI. I would not be surprised to see some sideways action followed by another drop coming back down to around 127. Going out to the financial sector, XLF. This is the strongest sector on the weekly chart that we have looked at so far. If we drop this to a daily chart, it shows a little bit different picture though. The 20 is not rolled over below the 50 like the previous chart we looked at, but it is getting pretty close. For a bullish trigger, I would want to see not only a break above 49.60 but probably waiting for a higher high and higher low confirmation on that as well. The likely path of least resistance for this is sideways and then another leg down in my estimation. Going out to healthcare, XLV. We have had a series of lower highs and lower lows over the course of the last several months. This is just a continuation of a bearish downtrend. We topped out, we broke down, and now we are going down and testing the 20 SMA on the weekly chart. This should hold at least temporarily. Whether or not we actually break that is anybody's guess at this moment, but we are pretty oversold to the downside in both the RSI and the MACD. So a little bit of reprieve here seems like it is warranted to me. I would not be shocked by prices coming up to around 141 or 142 and then puttering out and losing momentum and kind of going into a sideways trend from there. But we need more development and more analysis on that. Ultimately, we do have a diagonal that we can draw here, and we would want prices to get back above not only that diagonal, but probably all the way back up above the 200-period moving average around 147 before I would be interested in this to the bullish side at all. Going out to XLE, the real estate ETF, we are low basing right now after a gigantic drop. Low basing, have a little bit of kind of a base or flag pattern here. If we break below that or below the horizontal support right here, it is lookout below. If we toss this out to a weekly chart, you can see we are below all of our weekly moving averages, including that all-important 200 and our 50-period moving average. So this looks more like a short to me than anything else, and I will be looking potentially to take advantage of triggers to the downside on XLE. Now going out to our metals, if we go out to gold, put this out on a weekly chart, and you can see some weakness coming into the gold space. We've had some really nice runs, and this is the first time in a while, since all the way back in mid to early October, that we have had the 9 EMA flatline and start to threaten to cross below that 20 SMA. If we do get that cross and price cannot get back above these two moving averages this week, it is likely that we are going to see a sell-off in gold and probably coming back down to that 224 to 220 level. Now going out to silver, lots and lots of volatility in silver. We have a decreasing slope on the RSI and on the MACD. This is divergence with the chart because the chart was signaling higher highs and higher lows. So when these are not lining up, when one is setting higher highs and higher lows and the other is setting the opposite, that is time for caution. We have seen extra volatility come in, and to me, this looks like a stay away for now, or potentially even a shorting opportunity coming back down to 24.25. Finally, going out to our cryptos. IBIT is the ETF for Bitcoin that I track personally. Looks to me like a little bit of weakness here. I still have a theme that is bullish for Bitcoin. I am personally still holding my long-term positions, and those are going to continue to be in my holdings long-term. But on the short term, we are signaling some weakness here. I would not be shocked to see this come down to the 50-period moving average around $50. So another basically $4 drop from where it is, which would coordinate to about 8%. Going out to Ethereum, ETHA is the BlackRock Ethereum ETF that I track. And right now we are coming in close to that 50-period moving average. Haven't tested it yet. To me, this looks like it mostly just wants to go sideways. I would be a little surprised to see it break the 50-period moving average here, but if Bitcoin does end up going down or the risk off sentiment persists in the market and the market gets into a selling mood in general, anything can happen. If that 50-period moving average does break, honestly, I'm going to be looking at lower prices to come as an opportunity to add more to this position and not to sell what I currently have. Last but not least, let's go out to UUP, the US dollar index. We had a major gap down here a few days ago last week, and now we are low basing on that. This drop in the US dollar will help support equities a little bit. And if we put this out to a weekly chart, you can see we were threatening the last time we had this conversation for last week's video. We were threatening a breakout here with a close for confirmation that was looking to put in a 3-year high. So very, very good news for the market that we did not end up doing that. That confirmation here was a fake out, and we have since gapped down and are moving lower. Hopefully that trend can continue and we can see this drop down into the $28 or $29 level. Finally, last but not least, going out to our heat map, let's look at a 1-week performance, see where money is rotating in and out. And you can see last week we did have money start to rotate back into the market overall. But if we drop this back to a 1-day performance, which will show Friday, you can still see a lot of money being hesitant and moving out of specific areas of the market. It was selling across the board. So the discrepancy between these two basically tells me now is the time for caution. Don't be a hero. Play limited risk trades. Keep your stops in place and trade smart and safe. Last but not least, let's wrap up here. Going out to Forex Factory for our economic calendar for the week ahead. Really, we don't have any important economic data coming out through until Wednesday. Thursday, we have unemployment claims, which I'm not expecting to be super important to the market this week. And then we have ISM manufacturing PMI data. That will be the report that I am expecting to have the most impact for the market just based on where we are for inflation. But I don't think it is going to be an event that we have to avoid trading around. I think the market has a pretty good idea of where it is going to come in, and we haven't seen a ton of fluctuation in the numbers coming in for PMI data for a little while yet. So I'm not expecting that to be an issue in terms of overall stock or option positions. With that, guys, trade safe as always. Take care. Let me know if you have any questions. Hit me up in the comments. And if you did not watch the video from last week, I offered a chance to enter a drawing to be able to win a free 1-hour coaching session with me to help you get positioned to profit from the trading year ahead. To enter into that, watch last week's trading video for the 22nd, like the video, and comment saying you want to participate in the drawing on that video, and you will be entered for the drawing taking place in a couple of days here on New Year's. With that, take care, guys.